Placing investments in private companies takes effort and expertise. Unlike public assets, which are traded on open exchanges, private equity investments are made via individual deals. Finding these deals requires a deep network of connections across industries, and executing them requires a specific set of skills. Private equity firms take on that complexity, offering investors a vehicle for placing capital into privately held companies. That vehicle is called a PE fund. The fund is like the core product of the PE firm. Each fund follows a specific strategy and typically runs for a preset limited duration. PE firms, which are also called general partners or GPs, then sell these funds to their customers, the investors, which are called the limited partners or LPs. Private equity funds are an attractive asset class for LPs because they can offer some of the most attractive returns. Why might that be? Well, for a few reasons. One is leverage. GPs commonly use a highly leveraged investing strategy, which means bigger risk and bigger reward for LPs. Second is value creation. Since PE funds typically take a larger percent ownership over assets than public market investors, they can take an active role in the acquired company. This means they can bring fresh skills and expertise to create new value for the company and ultimately the fund. Lastly, because they invest in non-public companies, GPs access a wider pool of possible assets, including companies with higher growth prospects than most public companies. So let's explore the life cycle of the fund, which from start to finish typically spans 10 to 12 years. Before officially launching the fund, the GP will build a fund strategy, also called a thesis, that specifies what type of asset, industry, or geography the fund will focus on. The fund strategy is like the GP's secret sauce, the ingredients for success that differentiate it from other funds. The GP will also specify the terms of the fund, like the duration, expected returns, minimum investment amount, and how the returns will be split between the GP and LP. Next, the GP fundraises. This is all about selling the fund to LPs by presenting the fund strategy as an attractive investment opportunity. Fundraising happens on an ongoing basis, often for up to half of the life of the fund. Once sufficient capital is raised, the GP transitions to deploying capital into individual investments or assets. For each individual asset, the investment process consists of 3 phases. The first step is the acquisition, when the GP conducts thorough due diligence to select and purchase assets that align with the fund's thesis. Once acquired, the GP will hold the asset, and the focus in this period is on value creation, taking action to drive profitability through any number of cost-saving or revenue-driving strategies. And finally, when the time is right, the fund will exit the investment by selling its stake in the company. In some cases, GPs will hold assets until the end of the fund lifecycle. In other cases, they might exit sooner, if a favorable option is available. At this point, as the fund nears the end of its life cycle, the GP will typically start preparing for the next fund. Finally, once all the assets have been exited, the proceeds generated from the investments are distributed back to the LPs and the fund will close. Next, we'll take a closer look at each of the stages of the fund life cycle.